Hello, I'm Robert Vida McLeod, the Chief Executive Officer of Frontline Management. Frontline Limited is one of the world's largest owners of crude oil tankers. Frontline's 66 vessel fleet, including leased vessels and vessels under construction, makes it one of the largest owners of crude oil tankers in the world. The company has critical mass and a significant commercial scale in key asset classes, including VLCCs, Suezmax tankers and Aframax tankers. We are a large but lean organisation very focused on maintaining competitive cash break-even levels. For those of you who are unfamiliar with Frontline, the company traces its history to the 1980s. Hemen Holding, a company controlled by trusts established by John Fredrickson for the benefit of his immediate family, became the company's largest shareholder in 1996 and has acted in a manner of a fully aligned shareholder ever since. Hemen and its commonly owned affiliates is a global powerhouse within the marine transportation industry with a 55-year operating history. Frontline was listed on the New York Stock Exchange in 2001 and shortly thereafter commenced a tradition of returning value to shareholders through dividends and spin-offs. Since then, Frontline has returned over $4.5 billion to its shareholders as cash dividends. The company and its board of directors is committed to maintaining this tradition while continuing to grow the company. Due to our significant commercial scale, strong balance sheet and vast relationships in the market, Frontline is well positioned to be a market consolidator in the current environment, which I will describe to you. Global oil demand drives the need for the seaborne transportation of crude oil. Since 2014, global demand has grown by nearly 8 million barrels per day, growing at a rate of roughly 1.5% per year. A strong rate of growth is expected to continue over the next several years as low oil prices drive demand from emerging economies. An important dynamic that affects the crude oil trade is the distance oil needs to travel from its origin to its destination. In the shipping world, this is calculated in ton miles. Lower crude oil prices have driven production increases in the Americas, which are geographically dislocated from key demand growth centres in Asia. Specifically, Chinese oil demand has grown by nearly 3% year over year, and demand from India has grown by over 4%. Increasing demand growth is expected to come from these countries as well as developing African economies. The net effect for the crude oil tanker market is increased ton miles and hence demand for shipping. Additionally, global crude oil inventories are in decline after reaching peak levels last year, and the oil market is beginning to show signs of recalibrating. The current crude oil tanker rate environment does not reflect that strong demand at present, and this is largely due to the other side of the equation, namely supply. By supply, I mean both the global supply of crude oil and the availability of tankers to transport it. Regarding the former, OPEC mandated production cuts, which commenced in January 2017, have remained intact, although compliance from certain member countries has become questionable as the cuts have been extended. Less crude oil production means less export cargoes that need to find a home. In a weak oil price environment, those cargoes may be stored on tankers and resold at a later date, effectively tying up a portion of the global fleet. The absolute supply of crude oil tankers has had a more pronounced effect on the market. Over the last 2 years, the number of vessels in the crude oil tanker fleet has grown by 12.6%. Since the start of 2016, 82 new VLCCs and 62 Suezmax tankers have been added to the global fleet. We should expect continued fleet growth through 2018 as an additional 49 VLCCs and 45 Suezmax tankers are scheduled to be delivered from shipyards next year. There's been some new ordering activity this year, including vessels ordered by Frontline, but orders are limited and have been placed by large industrial owners as part of organic fleet renewal programs. Asset prices are at low levels that we believe are indicating the bottom of a cycle. What is different about the present environment is that financing is more difficult to access than in the past, and there has been less speculative investment, specifically from private equity firms, which have lost their appetite for shipping. This has reduced ordering activity across virtually all shipping segments. In stronger markets, old tankers may still be able to generate profits, but in weaker rate environments, owners face difficult choices. Eventually, aging tankers are sold for scrap. 20 years is widely considered to be the maximum lifespan of a tanker trading internationally. Tankers may extend their lives in certain intercoastal trades or in offshore storage, but these are not considered part of the trading fleet. While a good portion of the global fleet is relatively modern, over 20% of the VLCCs in the fleet are likely to be scrapped in the coming years. When you consider that the current VLCC order book is equal to about 13.7% of the existing VLCC fleet, it's easy to see how supply dynamics can quickly change. The VLCC segment is the segment that we have the most exposure to, offering us the most upside potential. Some owners are forced to scrap their vessels because finding suitable employment for an aging vessel is difficult. Generally, the decision is a simple financial one. The pace of vessel scrapping has begun to pick up over the last several months and is likely to accelerate, particularly if the winter season does not show strong improvement in rates. Looking out on the horizon, there are also environmentally driven mandates at the end of the decade that may force additional vessels to retire. In particular, the International Maritime Organization's requirement that all vessels be required to install ballast water treatment system during dry dockings after September 2019 will require further expense that may be hard to justify for vessels approaching the end of their useful lives. The question many market participants are grappling with is, where in the shipping cycle are we now? After enjoying several years of healthy rates, 2017 has been relatively subdued due to the factors I discussed previously. As I mentioned earlier, we believe we are at the bottom of the cycle. This is reflected in the rate environment, asset prices, and lack of speculative ordering. As we have seen in past years, Frontline has the potential to generate significant earnings well above our competitive cash break-even levels, which include bareboat hire, interest on debt, operating expenses, dry docking, and G&A expenses. We are a large but very lean organisation intensely focused on efficient and cost-effective operations. This serves us well in both strong markets and weak ones. We have a positive long-term view of the crude oil tanker market and believe we have positioned the company to be a leader in an environment that we think will be characterised by consolidation. Demand for seaborne transport of crude oil is expected to remain strong, and trade routes will continue to evolve with increased long-haul cargoes from the Americas to Asia. We are generally watching vessel supply growth, as this is the most critical variable. Using conservative assumptions, the market environment should begin to see improvement in the second half of 2018, perhaps sooner if the pace of scrapping increases faster than we expect. Looking out 2 years, significant expenses will be required by owners to ensure compliance with environmental mandates. We believe the effect of these mandates will be twofold. First, they will serve as a catalyst for further scrapping. Vessels that are 20 years old today will almost surely be removed from the global fleet by then. If they have not been scrapped, they will be sitting idle and completely uneconomical. Second, this may serve as a catalyst for industry consolidation. The tanker industry, like many other shipping segments, is highly fragmented with many small owners of 1 or 2 vessels. Some owners will not be able to be competitive during the current down cycle and may exit the industry ahead of the implementation of the environmental mandates. Weak markets often create opportunities for financially strong market participants. The risk-reward scenario following the drop in asset prices now appears to be more balanced, offering stability and upside potential. Frontline is in a unique position to take advantage of the current market. Despite being a lean organisation, we have a large presence within the industry by virtue of our scale, our long operating history, and our commercial brand. These factors, among others, enable us to cast a wider net of opportunity and to pursue accretive transactions backed by attractively priced capital. We believe our opportunistic approach to fleet growth will drive value appreciation over the long run and position us to carry on our tradition of return value to our shareholders. I look forward to keeping you updated on developments at Frontline as we navigate through the market cycle.